Land acknowledgement. As we gather together, we acknowledge the sacred land on which we reside. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Petun First Nations, the Seneca, and most recently, the Mississaugas of the Credit River. The territory was the subject of Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, this gathering place is still the home of many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our relations. Last but certainly not least, we acknowledge the people of African descent who were brought here against their own will or in search of a safe place to live their lives and raise their children. Reconnaissance des terres. En nous rassemblant, nous reconnaissons la terre sacrée sur laquelle nous résidons. C'est un site d'activité humaine depuis 15 000 ans. Cette terre est le territoire des Premières Nations Huron-Wendat et Petun, les Scéniques et plus récemment les Mississaugas de la rivière Crédit. Le territoire était sujet de l'alliance de la ceinture Wampum plat avec cuillère, un accord entre la Confédération Iroquois et Confédération des Ojibwe et des nations alliées à partager et à prendre soin pacifiquement pour les ressources autour des Grands Lacs. Aujourd'hui, ce lieu de rassemblement est toujours le foyer de nombreux peuples autochtones de toute l'île de la Tortue et nous sommes reconnaissants d'avoir la possibilité de travailler dans la communauté sur ce territoire. Nous sommes également conscients des alliances brisées et de la nécessité de nous efforcer de guérir toutes nos relations. Dernier point, mais non le moindre, nous remercions les personnes d'ascendance africaine qui ont été amenées ici contre leur volonté ou à la recherche d'un endroit sûr où vivre leur vie et élever leurs enfants.
Hi there. Good afternoon, everyone. How is everyone doing today? How's everyone doing today? I want to hear you in the chat. Thank you so much for joining. We are at the AAP, which is Ask a Professional at the BBPA. Nadine, I do see your thumbs up and I hope that your camera ready. Good, because I'd love to invite you onto the virtual stage, Nadine, just before we get started, just to welcome us as we begin 2023. It's going to be an amazing year. So Nadine, share with us.
Yeah, absolutely. It's so great to be here. Moy, thank you always for being such a great representation to us as an organization and for who you are. Thank you for your continued support and work that you do. It's 2023. Happy New Year. I think it's the first time I'm seeing you since the new year.
Yes, yes, yes. It's exciting. It's going to be a great year.
It is going to be a great year. You know, we are, I think, year 7 or year 8 into the decade of people for African descent. Yes. And, you know, there's a lot of work that has to be done still yet, but I'm very proud of what we're doing at the BBP and I'm very proud of what we're accomplishing. We still have a very robust program schedule. We have programs like this to really enable and create windows of opportunity for Black entrepreneurs in this country. And, you know, I'm looking forward to all that's to come in 2023. And, you know, we have the BBP Harry Jerome Awards coming up in April. We have our Black History Month, the rollout that's coming up in February. And then, of course, International Women's Month. So many things are happening. And I continue to be inspired by all of it and just thankful to all the people that we work with that makes all of this possible.
Nadine, you are an absolute phenomenon. I've been watching you and I'm so just impressed by the work that you do. So thank you for your kind words earlier. Thank you so much just for leading us. You're an exceptional leader, and we're so happy to have you. So for those of you who are joining, this is Nadine Spencer, or you've just joined and you don't know, this is Nadine Spencer. She's the CEO of the BBPA, and she and the team have been doing some incredible work here, and there's just so much more to come. So thank you so much, Nadine. I look forward to working with you in 2023 and beyond. So see you later.
Yeah, absolutely, Ditto. See you later. And I look forward to today's program. Thanks.
Absolutely, absolutely. So without further ado, again, I just want to welcome you. And I do see the Happy New Year and so forth in the chat. I really hope that you're all in very wonderful health, and everyone is just excited just to kickstart a brand new year. It's so great to partner and to be a part of something great that is happening in 2023. So what I'll do is without further ado, I'd like to introduce Mr. Chase Bethel. He's our professional for this afternoon, and he will be informing us about navigating risks. We're talking about the inflation risks, the things that are happening in the economy. He'll share a little bit more about that. Now, I'll quickly read his bio, and then we'll just have him join me on the virtual stage. So Chase Bethel is the U.S. Equity Research Analyst at Fidelity Investments Canada. And prior to joining Fidelity Investments Canada, he was Equities Analyst, Consumer Portfolio Management, and Researcher at CIBC Asset Management, where he was a member of the Equities Research Team and was responsible for the fundamental analysis of the North American consumer sector. He's held the position of an Equity Research Analyst at Desjardins Capital Markets, covering special situations, companies that included a number of Canadian consumer-related firms. And prior to Desjardins, he was an institutional investment analyst at Fidelity Investments Canada. It's a whole lot to say. You know what, Chase, if you don't mind, if you could just join me on stage, on the virtual stage, and tell us, because I just shared a whole lot. And as we're talking about investment and finances and interest rates and inflation and all of that, if any of you in this chat, please let me know that I'm not alone. If this is not your forte per se, right? And that's why we have people like Chase. Chase, let us know, what do you do in layman terms? What exactly do you do?
Well, good afternoon, Moy, and to members of the BBPA. I just want to say, first of all, thanks so much for having me to be one of your speakers in this series. And I'm honored to be here. And I hope that by the end of this session, we can all feel that we understand some of these sometimes very nebulous concepts that we talk about in the economy. But to make it really simple, if you've ever made an investment towards your retirement, such as in a mutual fund through your financial provider, which I'm sure many of you have, you probably bought into a fund that maybe is managed by a firm like Fidelity Investments. And I get to be a part of a team that tries to pick the best investments out there to help you reach your retirement goals. And so I focus on the consumer sector, as you've mentioned, and then there's others like me who specialize in different areas. So there would be another person at our firm who looks at industrials companies, another person who looks at financials companies. And so each of us are sector specialists, and then we bring to the fore our best ideas through our insights, and we put stocks in that portfolio that help you do better than the market and retire earlier. That's the simple way to think about it.
Well, that's good. Thank you. And I know you have a presentation, Chase,
Right.
and you'll be going through some stuff on inflation and so forth. Now, again, I know that when I go into the supermarket nowadays, prices for the food that I buy, especially if it's organic, it's costing me a little bit more. And I think maybe just to kind of like you break it down as you begin your presentation, what exactly is inflation? What exactly is inflation? Maybe just for those of us who may not be as familiar.
Absolutely. So inflation, in the most simple terms, is the rising of prices, or what you pay for any good or to consume in the economy. And I think maybe one of the closest to home ways to think about it is just going to the grocery store. So each of us on a weekly basis, it goes to the grocery store to fill our pantries, fill our refrigerators. And you've probably noticed that the celery sticks and the broccoli and the eggs are costing a bit more than they used to cost. And so when those prices are going up, that's what we think about as inflation. And it doesn't just happen in the goods, it can happen in services as well. And so, yes, that's the definition to think about.
And I appreciate that. I appreciate that. And we will get some resources for you, hopefully at the very end.
Yeah.
So for those of you who are joining and you've joined us, thank you so much for being here to hear about this, because I think regardless of whether like you're in business or not, at the end of the day, as you said, just a normal consumer going into we have families, right? We have households. And this is such relevant information at this time. So thank you so much for being with us. Please do get your pens and your pads. Chase will go through his presentation and we'll leave a few minutes, just like normal, at the very end to take questions. So get your pens and your pads and please record your questions, and I'm sure he'll be happy to answer them at the very end. Go ahead, Chase. Thank you.
Thanks so much, Moy. So just to get things started here, the first point I want to make, we already talked about my background experience. I really want to share the story of the 3 phases that I experienced as an analyst. And the end is more important than the beginning, but let me just tell you what I experienced. Coming out of, I was fortunate to go to Western University and to the Ivy Business School. And like many of us, you leave the education environment and you come into the work environment, and you've learned lots of very interesting tools and skills, and you want to put them to use. And you quite frankly think you know more than anyone else. And so there would be a little bit of naivete on your part, probably as someone who began as an analyst or whatever profession you were in, and thinking that you had all the answers. And then that's phase 1. You get to phase 2, which is you go into work one day and you kind of realize how little you know. And it really scares you quite a bit to consider, what you thought you knew, and then to come to find out how little you actually know. And in phase 3, which is the phase that I think I became a better analyst in, was when I came to the realization of the known unknowns and the known knowns. And I was still comfortable to be able to make decisions and also to come to terms with what I don't know, but maybe to think about probabilities around that. And so I say all that to say that while there's going to be things that I want to talk to you in this presentation, I'm also going to be comfortable to say to you, I don't know, if, in terms of certain questions, because I think that's an important skill that an analyst needs to have, is to realize if you don't have the answer to something, and maybe to think about where to go and find it. So risk navigation, and we've probably all heard the R word in conversations, maybe even over the holidays as you were celebrating, or prior to that, as people talk about this idea of a recession. And so the first point I want to make is that the R word and the recession, if it is to happen, it's not an input, it's an outcome. So we started the conversation, Moy and we did, talking about inflation and this idea of the above average inflation that we're seeing in the economy. One example I gave was grocery store prices. And so that then leads us to a central bank policy response. So when inflation is running above the central bank's target, which is usually a low single digit number, let's call it in the 1 to 3% range, is what central banks target. Some target more like 1 to 2, depending on geography. And when that goes above that range and it looks like it's going to be persistent, there's a policy response, and there are tools that the central bank has to try and make the availability of money more restrictive. And one of those tools is to raise interest rates. So we are now in this phase of our central banks in the economy have been raising interest rates. They've done so in Canada. They've done so in other geographies such as the United States. And then that gives rise to, well, if there's this restriction that's happening in the economy, isn't that going to maybe lead to less growth? And that's where the recession word comes in, and which is just defined as 2 consecutive quarters of negative growth in the economy. So, the first point I want to make about inflation is that it's really not a made in Canada issue. Prices have been rising globally. I have here a slide that comes out of the Bank of Canada's monetary report back from October 2022. And I've also updated for you So you can see where inflation is as of December. So we've seen a little bit of a deceleration in the rate of inflation, but it's still higher than what the central bank would tend to target. And so that maybe gives rise to the question, how did we get here? And I think for those of you that maybe did your economics 101 courses, you think about these supply and demand curves. And if we go back to the COVID peak period, things happened both on the supply and the demand side that led to the inflation that we're seeing. So firstly, on the supply side, many of us stopped working. We stayed put, we were under lockdowns. And so there was work that maybe wasn't happening. For some of us, remote work was possible, but for others, it was not possible. So jobs were not being done. And let's cast a wider lens beyond North America and think about the factory in China or in Vietnam. Well, people stopped working there too. So goods were not being produced that ultimately get exported and consumed by us in North America. So that's one thing that happened that led to a supply incident. The second thing is that some workers left the workforce. So especially those 55 years and older, many people with this lockdown and with the threat of health issues decided to retire. I know I had a personal anecdote of my son's kindergarten teacher. Now he's in grade 1, but at some point during the lockdowns and faced with the skills mismatch challenge of having to run virtual courses, she decided, hey, this is enough for me, I'm retiring. And there's probably many examples like that. And so we had a reduction in what we call the participation rate, which is when you look at the total population and then you compare that to the amount of people that are actually in the labor force or looking for a job. Then on the demand side, something else happened. Out of the experience of the great financial crisis, when the pandemic first hit, many central banks and policymakers were very concerned that, what would happen if people didn't have enough money, if they stopped consuming. And so some of us were fortunate enough to maybe have some sort of stimulus support check coming to us or some sort of help through that way. I know, for example, here in Ontario, the government even gave help for educational tools for kids who were in school. And so maybe some of that money could have been used. And so you had the ability for consumers to demand more, coincident at the same time with less production and less output. And so those two forces combined really set us off on the course that we're now on. And that gave rise to the issue of rising prices. And so now we have the central bank response. And when we have a policy response, which is onto the next slide here, the point I want to make is that it tends to slow GDP or gross domestic product. And what I want to focus on, there's a lot of numbers in this table, but maybe just go down to the line at the bottom that says world. And you can see the projected growth for the world economy. And what it shows is, what the Bank of Canada thought in July, and then what the Bank of Canada thought in October. And what's in brackets is the old number, and what's not in brackets is a new number. And what you can see is growth, their projection went down. And so when we get into this series of rising rates, what tends to happen is we get lower consumption, and that leads to lower growth. So right now we're in a period where we've had the initial spike in inflation, and what the central bank looks at are both the total inflation, but then they also narrow it down a bit and talk about these core measures of inflation. So trying to take out things that may not be so important to what the average consumer is consuming, or it would call tail distribution type changes in prices. And the two areas that I think are really going to set the tone for where things go from here are food and shelter costs. And then there's maybe a third one, which is services. So in chart 7 towards the bottom, what it's showing you, and by the way, food and shelter costs make up a total of 40% of the total measurement of inflation. So these are two income in combination, quite large categories. And then services, excluding shelter, make up another 24%. So we're covering about 2/3 of all inflation just by the categories that I'm showing you here. And what you could see in the blue bars is where the most recent inflation was actually above the trend line or the average leading up to that point. And so we had inflation rising in things like rents and mortgage costs, which are part of the shelter costs. We had inflation rising in the cost of goods as things like diesel became more expensive, as the cost to ship a container from, let's say, China to a North American port became more expensive. And then wages are also driving services to large degrees. So, if you think about your Starbucks barista, or you think about your favorite nail salon to go to, or your auto repair person, those people, nurses, people are seeing higher and higher wages, and the companies that employ them are raising prices to be able to afford to pay them those wages. And then we talked about the first example being food. And the good news about food is we're starting to see a deceleration, and I'll talk about that a little bit more. So on the next slide, this is actually looking over at the US. So we're no longer in Canada, but the data is more, I'd say, robust here in terms of being able to track this on an ongoing basis, which is why I'm showing you for the US, but I think it still makes the point. So if we're trying to become more optimistic that maybe we've seen the worst of this whole inflation dynamic and things are going to get better from here, and we focus on some of the categories like the food and like the shelter I just talked to you about, then let's look at prices for food. And so on the left-hand side, I have a trend line of the prices for food at home, which is your grocery store, and the prices for food away from home, which is your restaurant that you might go, or any, quick service restaurant or casual diner, like a sit down place you might go. And what you can see is that has peaked, and now this is through the month of December. Now that's starting to come down. So prices are starting to come down. Some commodities are a part of that. So, we can see certain commodities that go into the price of food beginning to slow, and that's feeding into lower prices. There's also an effect here where, just by virtue of comparing this year's price to last year's, because it was rising last year, we're going to have lessening inflation. So that's called cycling, the peak, or cycling a higher inflation. Then on the right side, what it's showing you is that, so there's a red line called real page asking rents, and that's like the most current rental price change that's being seen in the US economy for those looking for a place to rent. And it's showing you focus maybe on the gold or yellow looking line, which is this consumer price index for the US for rent. And what you can see is that actually the most current rents are already going down, even though what's being measured by the central bank is still going up. And so the fact that there's a lagging effect in the CPI, but the real-time data is showing us a reduction, means that we can be optimistic that some of these inflationary impacts that we've most recently experienced as consumers can be lessening in magnitude going forward. So where does that leave us? It's bringing us to what is the central case, or what most people think is going to happen right now in the economy, and that is that we're probably in Canada going to experience a low growth economy, or if there is a recession, a moderate one in 2023, and then followed by more normal inflation and GDP growth in 2024. And I show you there the Bank of Canada's most recent forecasts, and the GDP area is also further highlighted. So you can see the total just by a definitional reference for those that may not know GDP is defined as the sum of, or if you add up total of consumption, total of government spending, total of investment, and the net impact of what we export versus what we import to arrive at that number. And it's showing us there that, we're not the Bank of Canada at least is not expecting a recession as of its most recent forecast. Now that's just really a forecast, and we'll come a little bit more to that. But I do want to touch on maybe where the most risk is as interest rates are going up, and that's in the housing sector. So just this past week, the Canadian Real Estate Association actually put out numbers for the most recent month being December. And what those showed were that the volume of houses that were bought and sold, so transactions overall, were down about 40%. So, that just means more people are just sitting in the place that they're residing in and not moving around. And you could even see there are derivative impacts on that, because all of a sudden there's a real estate person, an agent that's not making a commission anymore, or there's a renovation that was going to happen because someone moved that isn't going to happen anymore. And then there's the price impact. So prices are down, call it 13% year over year. And then that gives rise to what we call wealth effects. So as a homeowner, and this relates really more to the middle class. So anyone from, let's call it the second lowest quartile of income up to maybe 99% X the one percenters, like you're going to have high sensitivity to what the value of your house is. Some people use, say, a home equity line of credit to finance purchases in some cases. So what your house is worth is going to play into that. And there's also the psychological impact of, who wants to really invest in a declining asset. So when an asset is going up, you're motivated to want to, fix your, change your floors, update your cabinets, so on and so forth. When that's not happening, maybe you're just going to put on a fresh coat of paint or fix what absolutely needs to be fixed. And so this is showing that the most sensitive areas are really like the new construction, the renovations, but less so, you could see at the very bottom, just before the food, beverage, and the health, housing user costs. So your maintenance costs, you're still going to do that. And I'd also make one more point here, which is, according to data from the Canadian Mortgage and Housing Corporation, or CMHC, most of us as Canadians actually have a fixed rate mortgage. So that means even as the Bank of Canada is using this tool of higher interest rates to slow down growth, there's still about 80% of us who haven't actually experienced anything yet. And so as we get into whenever your mortgage renewal date is on your fixed rate mortgage, then you're going to all of a sudden have to adjust maybe your household spending to account for that. So on the next slide, this is showing you what has happened with mortgage rates. And you can see the big spike here leading up to around 5.5% for both variable and fixed rate mortgages. And it's also showing you on the right side how much, if you were to take out a mortgage today, the percent of that mortgage that it would account for your total income. So in the past, it would be around, call it in the teens, 14 to 16% over time for most homeowners. At today's borrowing rates, it shoots up to over 25%. So that's a problem. And it's a problem that only some of us being, variable mortgage holders are experiencing, and some of us have yet to experience. And so what I think the investment community would be hoping for here is that somehow before we get other homeowners starting to experience the current rates that we're seeing, we actually see inflation slow such that the current rates can come down. And so that this won't be the experience of all, but rather of a few. So that leads into, what are the risks from here relative to that base case that I talked about, or the central case of a slow growth economy or a moderate recession. On the upside, so things that can drive rates higher from here, we do need to consider what happened during the COVID peak, which was that a lot of us saved quite a bit of money. all of a sudden, if you still had an income coming in, you weren't paying for transportation to go to work anymore. You maybe weren't going and eating out at a restaurant anymore. My personal favorite, you weren't going to kids' birthday parties anymore. I mean, don't judge me or anything, but like some of those kids' birthday parties are really, there's too many of those on the weekend. So I enjoyed having a few less of those to go to. And all that taken into account meant that you built up some buffer. Most households in Canada built up some savings buffer. And it means that even as this inflation's gone up, it's only taken now some of that. So I don't have a great data point for you in Canada, but JP Morgan, which is one of the big US banks, has been tracking this for the lowest income consumers, those that are earning less than $50,000 a year in the US. And according to their estimates, most consumers are only about halfway through those accumulated savings. So there's still some money that can be used to offset this inflationary impact before people are into taking on, a debt just to sort of finance or having to make a big adjustment in what they're spending on. The next risk is, with the Russia-Ukraine conflict, maybe there's going to be other disruptions that we haven't considered that drive inflation or keep it elevated for longer. Ukraine is like known as one of the bread baskets of the world in terms of all the grains that get exported out of there. And so right now there's an agreement that allows for some of those goods to move, but what if that wasn't honored is something to consider. And then one more to think about is that the Bank of Canada, when it gives forecasts, actually doesn't predict the exchange rate. And so it just sort of takes what is the current exchange rate and assumes that's going to be the case. So in other words, the market is right about the Canadian dollar relative to the US dollar and other currencies, but that may not turn out to be true. And so if for whatever reason Canada begins to look less risky relative to other places in the world and the Canadian dollar weakens, then think about the fruits and vegetables that we tend to import during winter months in Canada. Those are denominated in US and dollars, and so that becomes relatively more expensive and also could become inflationary. So those are some of the upside risks to consider. And then there are downside risks. So there are some who are worried that, hey, rates are already too high, and it's gonna, by the time the central banks realize that policy has become too restrictive, it's going to be too late to change things. And then we get into this, you may hear on your favorite radio show or some, financial, or read in some financial journal, this concept of a hard landing, which is to say, instead of that moderate decline in GDP, we end up with something much more significant that looks something like the Great Financial Crisis or a deep recession. Another thing to put on your radar is that we could actually see deflation in prices of certain products. It probably won't happen in the first half of this year, but potentially by the end of this year. And that's because some of the drivers of inflation, as I mentioned, are now rolling over. So I can think about, for example, that 40-foot container that's coming from China. The price of that container now is back to 2020 levels on a spot rate basis. And so shipping costs are down. For example, diesel costs are down. And so there's an argument to make that just compared to last year, some of these prices will move lower. And therefore, that makes an argument for lower interest rates over time. I do need to mention there's a case kind of in between here that I don't think many people are talking about, but that gives me some concern. And that is, what if inflation doesn't stay at, call it 6, 7, 8%, but also doesn't go down to 1, 2%, and we end up with something like a 4 and a 5 and a 4 and a 5, and each month or goes by and we're measuring inflation and it's just sort of sticking in this higher range because we aren't yet at a point yet that the demand function in the economy has become lower. And I think that's a real possibility. And it goes back to the point I made earlier about the fact that many homeowners still have accumulated savings. Many homeowners have fixed rate mortgages. And so as a policy tool, rising rates could be less effective or have a less immediate impact this time around than in the past. So I want to end here because I do realize that some of the audience or much of the audience are business owners, and part of the key responsibility I have as an analyst is to talk to companies. At Fidelity, I think this is one of our competitive advantages, is how often we can get into a room or meeting with a CEO or CFO of a company and hear what they're saying and doing, and then make investment decisions more broadly for a whole sector. And so here's a few things to think about. The first is anticipate the central case, but prepare for the worst case. So, you probably want to sit down in some of your meetings and do some off-ramping of, hey, economists and the central bank thinks that we're probably not going to have a recession this year, or it might be mild, but what if that doesn't happen? And where will we be able to reduce our costs, or what are some growth initiatives that we have that can help us do better than the market? Innovations, these are things to think about. The second is there are still areas that could get worse, and that would only make them back to normal. In the US, the US banks are pointing to, for example, credit card charge-offs. So there's a certain percentage of borrowers who borrow on credit cards that simply don't pay those debts. And right now that number is 1.5%, but historically it's been 3%. So it can still double. And that means if you're someone who is exposed to, you lend to enable a consumer to buy your product, and then you have a receivable in your business, you probably want to make sure that you're allowing for some higher credit losses in the future than what you've experienced most recently. The next point here is on what retailers in particular are doing with inventory. Many best-in-class retailers, think about Walmart and Target, for example, are taking a two-pronged approach. And what they've decided to do is, for some of these products that are long lead time, so you buy it today and you get it 6 to 12 months, they've made the decision that, hey, we're okay to maybe have not enough to satiate demand. We'd rather chase inventory. So if we realize we don't have enough, maybe we can try and air freight something over, or use some sort of a faster way to get the product than we have in the past. But we'd rather have too little than too much. And so I was on a call recently with one of the big distributors of electronics products in North America, and they were talking about, through the holiday period, seeing things like televisions down and computers like PCs down in the 20 to 25% range in terms of sales, and also anticipating that they still needed to clear product because they didn't sell enough during the holiday. And also considering that, hey, because we were so busy just trying to make products during this period of high demand, we kind of dropped the ball on innovation. So, what's coming in 2023 as far as some of these categories is more evolutionary than revolutionary, and therefore we don't have a lot new this year. So, if you're exposed to some of these categories, something to think about. And then on things that are like more high velocity, where you're going to sell that product, maybe it's like perishable, or you can get that product within weeks rather than months. You want to just be in stock, not give the customer a reason to go somewhere else. Point number 4 is re-engage with your suppliers and service providers. So if you are someone that's importing, even on the trucking side, I've started to see signs that as of December, truck freight is starting to see lower rates on a year-over-year basis. And so maybe there's an opportunity to knock on some doors and see if the contract still is the contract, or can we renegotiate that sooner, and what can shake out there. Point number 5 is really important. One of the experiences coming out of the pandemic was that many companies who furloughed employees or laid them off are really ruining the day that they did that. And I've talked to a number of companies that say, hey, this time around, especially in light of some of the demographic factors that are leading to a tighter wage market, we're going to be a lot more slow-footed to lay off employees. And so, for your business as a business owner, be sure that you're comping your wages and not underpaying your people, because I'll come back to that point, but be sure that you're not underpaying your people. And also, when you're thinking about what you can do in the event of a slowdown, Maybe this isn't the first place you want to touch in your profit and loss as far as your expenses. Coming back to that whole idea of turnover and paying the right price for wages, a lot of companies have found that even in cases where they've made hires, they're not getting the productivity they used to get from new employees. And one of the factors, especially, and it just depends on the type of environment you're in, but let's say you're running a factory and you have a shift or a team of people that are in that factory, and one of them leaves or two of them leaves, and it's, maybe 15 in total, just making up numbers here. It's okay when you bring in that first to second person, because the other 13 people can tell them, hey, here's a little nuance about how this machine works. And if you do it this way, you won't have any issues and we won't have to stop the line. But when you have half of that team or a substantial number of people coming in new, the whole curve around productivity really changes. And so you don't want to be in that situation of having to bring in too many people and having to train them all at the same time. You want to have a trainer who can train, sort of like a train the trainer type situation. And the last point here is to keep investing in secular growth areas. So, e-commerce is an area that continues to grow, for example. Keep investing in innovation. That's what's going to differentiate you as a business person. I did want to, before we get to questions, just leave a few other last parting thoughts, which don't necessarily relate to the topic we spoke about, but I think are relevant to business owners. The first is that I still see signs that there are areas of leisure that we haven't fully seen ourselves get back to the pre-COVID trend on. And so I do think that, we'll still see demand for example, I was on a call listening to what's happening with cruise line bookings, and still robust demand, people looking to get out there and get on a cruise. So if you're someone in the service business, maybe even as the economy slows, just by the fact that people are mobile again, the shutdowns aren't as strong as they were, you're going to see good demand for your business. The second is we have this dynamic of the China reopening. So after a zero COVID policy, the Chinese government has changed their approach. And so that's going to have reverberations, not just for, travel and tourism, but even I think, we could think about, there were probably goods that were not being demanded, therefore commodities not being purchased during the period of this lockdown. And so that's something to consider, even as we see some slowdown in certain commodity prices. I'm watching to see if this reopening dynamic might change the trend as Chinese demand starts to ramp back up again. I was listening to a call by Starbucks recently on, going back to their November call, and they just talked about, I think they went from, their business in China being down like 40% to down 15%, but considering it at that point, there was another lockdown, they thought it might get worse. So the point is, there's been demand that hasn't been coming through and that's a big economy and one we need to think about. The last is this idea of deglobalization. So I remember when I was coming out of business school, it was all about globalization. There was this economist, Joseph Stiglitz, and he and others were writing about this idea that, hey, if you're in an economy and you have a competitive advantage in producing a certain good, and then another economy has a competitive advantage in another good, you should each stop producing everything else. This is a very extreme example, and focus on whatever that is. So if Canada has, resources such as oil and gas and the oil sands, or maybe we're good at building armored vehicles, we should only do that. We should not go out and, for example, start to build fighter airplanes, because that would not be efficient. But COVID kind of taught us something else. I think there's like this whole strategic element of things. So the United States would say, hey, do we really want all of our chips coming from China and Taiwan in the future? We in Canada might say, hey, that was kind of embarrassing when we had to send an airplane to China to get masks and other PPE, only to have it fly back empty. And there are certain things that we maybe, or vaccines, we used to have a vibrant healthcare industry and pharmaceutical industry based in Montreal that has been hollowed out. So, there's this whole idea of onshoring or reshoring. I think that's coming through even in the Inflation Reduction Act that's just been passed in the US. And so it's something to pay attention to, that it's not just about lowest cost. There's a strategy overlay that's happening, and something to think about in your business. So those were my thoughts. I hope I wasn't too wordy and verbose there. And thanks for your time. And Moy, let's hear our questions if we can help anyone with anything.
Yeah, no, absolutely. And thank you so much for that. Very informative. And again, I hope you did take notes, or did take notes, yes, and then also write your questions down, because this is the time for to answer your questions. I do have one by Tamara, who says that inflation is really digging into the profits of her business. As a cold pressed juice company, the cost of raw materials have skyrocketed. How is inflation impacting small businesses, loans, and investments? Now, this is a great question. Thank you so much for asking that, Tamara. And Chase, you can stop sharing.
Can you just repeat? Yeah, can you repeat the question one more time? Just so
Absolutely. So, so inflation has definitely impacted her business. She's a cold pressed juice company, so the cost of raw materials have definitely increased. How is inflation impacting small business loans and investments? Yeah.
Okay. So I can tell you that it's been quite a dramatic impact. I'm going to think a little bit more. So prior to this whole period of rising interest rates, one of the dynamics in the investing world was this idea of these unicorn companies. And so a unicorn, just to sort of break down the parlance there, is just, this was the phraseology given by investors to companies that they had some sales, they had no profit, and maybe they didn't even have a way they were going to make a profit, but they were just growing the sales. And so, companies, if you were like in the electric vehicle space, if you were in the crypto space, depending on being in the right end market, you could go and borrow or get venture capital funding, or borrow money to advance your idea. And I will tell you that, yes, a lot of businesses have seen challenges getting access to capital. So I don't know in particular on loans, but I imagine it's all a function of the same thing. Equity capital more expensive, debt capital more expensive. We went through a period too where so you have the borrowing rate, which is like, there's the prime rate that we all pay attention to, which is the rate that best customers get. And then there's also usually a spread on top of that. And depending on how risky your business is, the rate you borrow at will tend to be within that range. And during the peak of everything was great, that spread got really narrow. And so you benefited not only from rates being, call it 0.5%, but also the spread. Maybe it used to be 400 and then it went to 250. So you were borrowing the 0.5 plus a 2.5 instead of a 4. And so that has now widened out. So there's two things that have happened. The absolute prime rate has gone up, and then the spread for the credit risk of your business has also, unfortunately, widened to what is the historical level as a result of this. I would also, one thing I would say is there are many companies in the beverage space that are testing the limits of price elasticity. So different types of companies, so like much larger is the ones I deal with, but just to make the point that it's probably worth a try if you can innovate or have a new product that you put a higher price on, and try and see if you could recover some of those costs. And I think companies that do this well also take time to educate their employees and train them on how to communicate with customers what is happening in the business. So if that's something that applies to you, it might be harder if you're not. So if you're like a pressed juice company selling to another company that then sells to retail, that's a little bit harder, because then you're in a business to business situation, and negotiating with the other company might be hard to raise your price. But if you're selling to an end consumer, think about the possibility that maybe you can raise price, and you probably, yes, you might sell less, but it might be less than you think. That has been the experience with a lot of beverage companies, at least the larger ones that I look at. Some of them raised price by 9, volume went down 1. So they were still able to be better off in the end and keep their margins strong.
Thank you so much for that, Chase. And Tamara, thank you for asking that question. I do want to say, I do apologize just for, what you're experiencing, because as a business owner, we know that cash flows is the biggest thing that impacts us, right? And if prices have increased, then cash flow has decreased, which makes it even more difficult. And I would presume that as it pertains to the banks, they want to know that you can pay their money back. Now, if everything is on an increase and we can barely afford to, let's say maintain the business, that might be something that they would look at to say, well, can you pay it back in this sort of climate? So that was a great question. We're welcoming more questions. Oh, you're welcome, Tamara. Any other questions? Chase, is there anything else? I guess while we're waiting for the questions to be asked, is there anything else that you think maybe just as small business owners, because we do know that everyone is impacted by inflation, the consumer, the business owner, everyone. Anything, even in terms of resources, like how can we better equip ourselves as business owners to really navigate this climate?
Yeah, no, that's a great point. I share my empathy also to Tamara, and I hope that you're able to solve for that financing and keep your business open and running. So Moy, we did talk, and you had asked me about this, and I had a little bit more time to think about it, and so I did have some extra resources that I took time to jot down, just thinking about what could be helpful here. So there's one. For those that are like just want the short version, there's this website called Blinkist.com, and there's a book up there, Inflation Matters, but they also, the whole shtick around this site is they give you like the key points if you're short pressed on time to be able to read everything. And so, and there's also an audio summary. So it has like the 5 key points. You could press play and it talks to you about inflation, why it matters, and some of the key elements of it. So I thought that was a great resource that people can take a look at.
Certainly. Would you mind putting that in the chat? I think, is it BLINKIS.com?
Yeah, .com. Yeah.
Okay, perfect. Thank you.
And there's also The Economist magazine that I read regularly. It comes out on a weekly basis. I think it's a great resource. And for those of you that are in the GTA, I mean, pro tip for 2023, like you go to the Toronto Public Library and get a card, then you sign up on the Libby app, and then you can read this for free. So it does has I think there's a subscription price if you were to buy each edition, but this is available for free just by having a library card in the app. So that's something that you can read and pay attention to. And then I love listening to podcasts, especially I find it an efficient way when I'm taking the train into work, or just doing, maybe I'm at some I'm watching the kids do their karate, but I'm also kind of listening in the evenings. And so these are some of the podcasts that I listen to that I find, and some of these are not just about investing, but just broad knowledge. So the Knowledge Project is one of them. Investing by the Books, Invest Like the Best, Capital Allocators, and Value Investing with Legends. And I'll put these into chat as you've asked me to do.
If it's not too much, otherwise we can find a way to provide it afterwards. No, that's really great. As again, we need to be in the know as we navigate this. It's the economy it's quite something, and we see it like we mentioned in the beginning. We see it primarily just going to the supermarket. Like that's the most obvious. You go in and you pick up 2 things for $50, right?
Yep.
Oh man, so we're here to have any questions. We have Nadine Spencer saying, thank you very much, Chase, for the relevant insights and for taking the time to be with us here today. Thank you, Nadine, for saying that. Thank you so much. And Kathy Grant says, encourage everyone to get a Toronto Library card, great access to information, articles, and it's free.
Yep.
Yes, thank you so much for that. And Anthony asked, how important is it for the Black community to support local Black businesses to develop and grow community wealth?
Yeah, so I mean, if you were to ask me why am I doing this event, like that's my motivation. Like I hope that just by sharing some of what I know, that it's going to help Black business owners fare better in this uncertain time that we're going through. And I think it's absolutely important. I'm pretty sure that the BBPA is taking steps to, make available to everyone that's a member, to know, hey, who does what and who's involved in what business. I hope that sort of networking is available. And so I think it's ultimately very important. And that's my number one motivation for being here today.
I appreciate you saying that, Chase. And for those of you who are listening in, 100% at the BBPA, this is what we're here for. We're offering free. This is like, well, it's not free to run the program, but you're getting it for free, right? So this is like information that oftentimes it would be very difficult for you to find an expert or professional who will sit with you and explain how these things work. And of course, we're really trying to equip you so that you can truly thrive in these tumultuous times. So I really appreciate you sharing that, Chase, and I thank you so much for your contributions to the Black community. And Anthony, I hope that certainly answers your question. And let's be more conscious, I think, in terms of just, how we spend and who we're spending with, right? I think that's something to take away. So SC or EC, I hope I'm pronouncing it correctly, says, thank you, Chase, for the wonderful insights. Now, we still have time for a couple other questions. We have a few announcements at the very end, but if you have any other questions, any last minute, we're here. Kathy Grant says, I make a point to visit Little Jamaica a few times a month to support a business, and also aim to support a Black business, restaurant, etc. Thank you so much, Kathy, for doing that. That's definitely living with intention as it pertains to supporting Black businesses. So thank you. Ken Tucker wants to know if it's possible to put any of the links in the chat. I think we.
Yeah, I'm trying to do that. Maybe it's because I'm a co-host. I'm not seeing the chat room, but I'm gonna make a way to get it. Maybe we can put it on the site somewhere. I don't know. I'll try and make a way to make it available. But right now I'm not seeing the chat box on my screen.
Perfect. Tamara says, love all, while you're trying to do that, Jace, Tamara says, love all the mindfulness to the support Black owned businesses. Question, I think it would be helpful for me to stay on pulse with consumer trend reports as we navigate inflation, and a lot of the resources I find online tend to lean towards US stats. Do you have a resource for industry market reports? I think that's what we're speaking about now, right? Okay, so we're sharing. Go ahead.
Yeah, I think that's, so I would agree that there's not, so I haven't at least found a great Canadian content focused type of web podcast or website. So I agree with that point. I one of the things that I look at, but it's I hope it could be something that maybe gives as much relevant as irrelevant information, but there is you can subscribe to StatsCan the daily. So if you go on the Statistics Canada website, or you even Google search StatsCan the daily, you can put in your email, and so every day Statistics Canada sends out information, and it ranges from a broad amount of topics, whether it's immigration trends or what's happening in the economy and whatnot. And so some of them maybe you click through because they're interesting, and others you may decide not as relevant to you, but it is a great resource, at least just for having something in your inbox that reminds you to read in and check in on what's going on out there.
No, that's good. Thank you so much. Very helpful, Tamara says. Thank you so much. Now, well, Chase, we're just at that time. I do want to take this opportunity just to thank you once again, as Nadine had mentioned earlier. Thank you so much for the time that you've dedicated to us today to provide this incredible insight. And some of us, if we don't understand it, the resources are there. And the more we, engage, and the more we listen, is the more we'll learn. So thank you so much, Chase, for your time, and we hope to have you again. Thank you on behalf of the BBPA.
Thank you for having me, and I definitely love to do it again wherever I can. And I've sent to you, at least more by email, the sources that I had. So maybe if you're able to put it into the chat before everyone.
Sure.
Yes, and we'll all be able to get it. But thanks so much for having me. And again, I just hope that maybe if there's just one line of what I said that helps a Black business owner this year, that's enough for me. So I hope that it was helpful to you all.
You're great, Chase. Thank you so much for having, and just in the chat, I mean, we've all sort of been saying thank you, but maybe we can use our little reactions just to give him a clap, a virtual clap. Thank you once again, Chase. And again, those links will be sent. They've been sent to me and I will send them to the program manager, and then we'll find a way to get them out to you. So here it is. We're at the very end of our show. Mohammed has raised his hand. Mohammed, did you have something to say? I don't want to ignore you. Did you have something to say? If you can, are you there? Okay, maybe not. Okay, he says no. Okay, great. So okay, perfect. No worries. So what we'll do, we hear clap. Oh, that's the clap. That's not. My apologies. Okay, perfect. Okay, so we do have some announcement. Next week, you do have some treats. I don't know if we can put on the screen. Next week, we will be, or this Saturday, which is the 21st, we are continuing the Building Black Wealth series, and it will be session 2 of the employment realities. Okay, so the topic, I suppose, would be the employment realities, and it is Building Black Wealth series. It's hosted by Roderick Barrington, and that will be Saturday, January 21st at 10 a.m. And then next Wednesday, you have a beautiful treat. It's Nadine Spencer. She will be hosting a day in the life of the Globe and Mail. So we have our guest speakers who's Solana Kane, Garth Thomas, and Susan Kelly. So feel free to tune in, invite your colleagues and friends. We're pretty much here every Wednesday, folks. So join us at 12 p.m. Okay, so next week, Nadine will be hosting a day in the life. And once again, on behalf of the BBPA, it was such an honor just to be here with all of you. Thank you just for joining each and every day, each and every Wednesday. And I hope to see you next week, okay? Thank you.
The Business Advisory Implementation Development Service. The BATES program is a major step forward.
I believe in the economy of women. I believe in creating our own space, creating our own financial freedom.
How do you get business? How do you get financing? How do you get approved for government loans?
We have to understand and recognize what the barriers are. And then we work to break those barriers down.
We're going to sit with you and we're going to wrap you around the best experts we have.
So time is money. The more time you lose, the more money you're losing.
Success does leave clues. And if you pick up on those clues, you too can ascend in that same path.
As an organization, we've really made specific efforts to help you pivot so that you can thrive.